Conquer the Crash, Robert Prechter. It sold a few copies. People pay attention to the gentleman from Georgia. Robert, great to have you on today.
Yeah, thanks for having me back. You know, you're one busy guy. Radio in the morning, TV in the afternoon. I mean, that's a long day.
We do that, and we enjoy it. And what's great, Robert, is they're very different. Why is this crisis different from the last time you were in cash, you got long in early 08? What's the difference between now and then?
Actually, it was early 09, so just to make sure we're on board there. So far the difference, if you look at the technical aspect of the market, is that this decline is a little bit more severe. The advanced decline ratio on Monday, for example, was the greatest on record going back to 1926. That's kind of a wake-up call. I think it's a confirmation that we're in what I call wave 3 under the Elliott Wave model. The first wave down was the 07 to 09 drop. I think we're in another declining portion of the bear market.
So we're still within that. Bring up dreaded first chart. Elliott Wave, love it, legitimate theory. Here, Bob Prechter, is Colgate-Palmolive. I just picked one representative blue chip stock. They make boring toothpaste. How does Elliott Wave theory adjust and adapt to these blue chip juggernauts that over a decade, over 2 decades, seem to get it done?
Well, you know, what happens in these declining mood phases is that people get more cautious. What happened in 07 to 09, people pulled in their horns. The first thing they did was they stopped putting out ridiculous mortgages or, you know, 110% of house value. Creditors began to be concerned about the actual value of the underlying collateral. Stock sellers came in. People pulled in their horns in business, and we ended up with some a negative quarter in earnings. Now we're getting the same sort of thing, and it shows up in different ways. In the first part of it, usually people turn to a different type of stock. They'll turn to a so-called defensive stock.
Right, like Colgate.
In a bear market, yeah, like Colgate or Campbell's or something like that. But you know, it's very difficult to buck a bear market. If you absolutely have to have your money in stocks, you know, well, then you've got to do some picking. But it's a luxury for the average investor who really doesn't have to do that. He can stay safe and wait for an opportunity overall.
How do you respond to an Ibbotson-like chart? Let's bring up chart 2. We've shown this many times before, the Dow back before the Depression. There's a lot of Prechterian volatility there, but the fact is it's going, as Gartman would say, from the lower left to the upper right. Are you saying you don't want to participate in the long-term growth of equities somewhat approximating nominal GDP?
I definitely want to participate in that, but you have to pick your moments. You have to pick times when stocks are cheap and people are negative. A great example was March 09. You know, one of the most bearish news events in recent times, I think, which is rather ironic, was the big reports of near record earnings and record earnings for a huge portion of the S&P companies. And everybody said, well, that's bullish. You've got to own stocks. You know, they're going to reflect earnings. But if you think back, what was going on at the bottom? That's when they were reporting losses, you know, for the first time ever. Right. And now it's record earnings. So when do you want to be a buyer and when do you want to be a seller? Those are the kinds of things I look at.
Okay, here's the book, Conquer the Crash. Robert Prechter, really a quite excellent book. Whether you agree with him or not, it is a fascinating read with some terrific charts. What's a single thing? Let's do this quote right now. Thank you, Rex. Being unprepared will leave you vulnerable to a major disruption. Being prepared will allow you to make exceptional profits in the crash and the ensuing recovery. For now, you should focus on making sure you do not become a zombie-eyed victim of the Depression. Bob Prechter, my producer Rex says I'm zombie-eyed. We're all zombie-eyed right now. When do we know to get into stocks?
Well, the first thing we've seen down from the high is a rash of editorials and commentary from people. Whatever you do, don't sell. The market's down too far to sell now. You know, the majority just never wants to let go. But if you recall back in 07 to 09 again, that's what happened in the first year of the decline from October 2007 to October 2008. People said, you don't want to sell. This is a setback. It's a pullback in a bull market. But by the low, if you remember February of '09, people were capitulating. They were finally afraid. We had some of the most extreme sentiment figures on record.
And we're not there yet.
So we're in that early, no, we're in that early phase still.
Okay.
But you know, you're market savvy. You saw the trend yesterday at 5.7, so that told you there was going to be a bounce here.
Okay, that's a break exclusive, folks. Tom Keene is market savvy. Yeah, so's Victor. Okay, let's come back. Robert Prechter with us. We're going to continue our discussion. I want to know, Robert Prechter, on the bubble of all. Is it a bubble? Is gold a bubble? Except gold was just as gold to the moon, that $1,800 print. Robert Prechter with us. Let's bring up that gold chart, Bob Prechter, right now. Real gold, inflation adjusted. You can see the 1960s. And then you see the Nixon years, and up we go to the 1980s, and then down we go. That long, long period where gold didn't work. Bob Prechter, is gold at 1,800 different now versus when it was inflation adjusted 1,800 30 years ago?
That's a good question. Let's set this up just a minute. You know, I'm really fascinated recently with what the market's doing to consensus opinions. Now, 6-9 months ago, what was the consensus among everybody about interest rates? And I'm talking about the people who are bullish on the economy and the people who are bearish on the economy. I bet you didn't have a single guest who came on and said interest rates are going lower.
Correct.
Well, I mean, the bulls knew they were going.
Yeah.
Okay, well, people said, you know, the economy's recovering, so rates go up, and the people who thought it wasn't going to recover said, you know, the U.S. Treasury's going to have trouble selling its bonds, rates are going to go up for that reason. So rates have been going down, bonds have been barreling upwards. They went right through the Moody's downgrade as if it never even occurred, both before and after. A couple of months ago, again, more consensus about the stock market was fine, earnings were going to pull it out, we would resolve the debt crisis and so on. Same thing with commodities. You have to own commodities. Well, today, I bet you probably don't get a guest on who says, you know, gold is overpriced here, you don't want to own it, or you don't want to buy any more. But here's another consensus, and to me it's the only one left. People say, well, you need gold now in your diversified portfolio, but back when it was $253 an ounce in 2001, people weren't saying that at all.
So what do you do here at 1,800?
Well, I say you hold on to whatever you bought at low prices, but you definitely don't. You don't want to buy. At least I don't want to buy it here, and I could be wrong. I've been wrong on gold for quite a while. But at the same time, I know an overbought, overpriced market with a huge consensus when I see it, and I just avoid them because that's where the hidden disasters come in.
Let's switch to politics here. Alan Meltzer, Carnegie Mellon, of course, his 2 volumes on the Federal Reserve, blistering op-ed today in the Wall Street Journal. The central issue facing this nation is whether we turn away from unsustainable budget and trade deficits toward an economy that grows at historic rates with low inflation. His essay on Get It Together on long-termism. Robert Prechter, your thoughts on what you've observed in the last few weeks of our short-termism?
Well, people are very short-term oriented. You know, even the Fed came in and did something that I thought was a very bad decision, and that was QE2. They did it after the market had rallied for quite a while and the economy had recovered. They were pretty smart back in '08 when they came in after the market had been down a lot. People said, oh, eventually they said, well, the Fed helped save the market. Of course, it took a whole year. But this time, I think they wasted a lot of ammunition and a lot of their prestige on doing this now. It's going to be very hard to do it on the way down. But here's the problem. The market and debt have been climbing ever since the 1930s. So there aren't any short-term solutions. The world has created such a massive volume of debt. Interest rate payments are going to be nearly impossible for debtors to pay. And that's what the markets are working out and trying to figure out. And I think eventually we're going to see deflation as a result. In
your book, and I'm not going to bring it up now because of time, you just say get out of your retirement accounts and get into cash. How do you respond to companies like John Deere with all of their international exposure that seem to be doing a good job generating nominal GDP revenue growth and ample cash flows? Aren't there things we can buy, Bob?
Tom, I'm not a stock picker. I'm pretty much a macro guy. I look at sectors overall where you want to be. Do you want to be in commodities or stocks or cash? So that's where I am. We'll leave that to the smart guys, but I do think that there are times when the stock pickers are overwhelmed by markets, and one of those times was in 2008. You know, the most famous stock pickers in the world had declines of 60% and as high as 75% in their portfolios.
Right.
So these big waves are when you have to really pay attention and decide, do you want to be exposed heavily at all?
Prechter on the banks.
So anyway, look.
Well, go ahead, Bob, please.
Sorry. That's right. I was just going to say, I want to stress one thing. Nobody has to be hurt, and that's why I wrote this book. I really was trying to help people, because my argument here is risk off with a capital OFF. You want to be liquid, you want to be safe. There are going to be some terrific buying opportunities in the next few years. I just don't think now is one of them.
Let's talk to banks. Earlier this morning on Bloomberg Surveillance, I spoke with Gerard Cassidy of RBC. He's been following the banks since Hamilton was secretary. I asked him if the banks, did they miss it, get it wrong by not raising capital?
I think the cash call for the U.S. banks was done very effectively. The U.S. banks have raised over $500 billion since 2007. But I think you're onto something when it comes to the U.K. and European banks. They didn't seem to be as aggressive in raising capital when they probably should have been.
Gerard Cassidy, RBC, the banks.
Probably is the central area of my book, Conquer the Crash, that I talk about.
Yes.
The banks were so loaned out, and all to consumers, almost all to consumers, not to businesses that could generate money to pay them back. Consumer loans at a crisis point are the weakest loans out there. So that's why we're in trouble.
Very good. Robert Prechter, generous of you to come to us today. Appreciate it.